You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton, and I have with me a distinguished guest today, one of my earliest mentors in this space, Mr. David Lindahl. David, welcome to the show. It's a privilege. How are you doing, sir?
I'm doing well, Chad. How's it going?
Going well, going well. You know, we've wrapping up a deal that we've been working on for a while, and you know, really just trying to stay up with what's going on in this crazy market that we're in with all the new forces. But that's us.
It is really crazy right now, for sure.
Well, David, you have one of the most amazing stories. I'm looking at two books you've written behind you. For those of you who can see the video, Multifamily Millions was the blue book that started it all for me. It was a paradigm shift. But I'd love to just let you kind of tell the audience how you went from being a landscaper to an operator of how, I don't even know how many units you have operated in your career at this point, but I'd love to just hear a little bit who you are.
I was in rock and roll band for almost 9 years. From the time I was 16 years old, I came out of that and I just wanted to make some money. I started being broke and I was looking for all kinds of things to do. I started that landscaping business. From there, I was looking at doing ceiling tiles and franchises. Even though I didn't have any money, I was looking for ways to get in with no money down. Almost opened a laundromat. Matter of fact, my father was going to finance the laundromat. My father was very conservative. The night before I was supposed to close, I was still living at home. He looked at me and he said, "I can't do it." And I knew exactly what he meant. And I said, "You're not going to fund me the money for the laundromat?" He said, "I just can't do it, Dave. I'm not sleeping at night." I was like, "Oh, shoot." And that taught me my first lesson, is don't always have a backup plan, because I couldn't buy that laundromat because of that. So that's when I got this Carlton Sheets course on how to buy real estate with no money down. I figured I wasn't going to rely on anybody anymore. It was going to be all me. And I got that course. It told me to go to real estate investment clubs, look at people just like you that are doing it, know that you can too. And I did, and that was an eye opener. And then I bought my first couple of properties with no money down, the 3-family apartments. I did it with credit cards. And then from there, I kind of stepped my way forward. You know, there's a lot of fear in doing your first deal. There was nobody out there teaching like there is, like everybody's out there teaching now, but there was nobody out there teaching back then. So I had to try to figure it out myself. So there's a lot of fear. It took me about 9 or 10 months to do my first deal. I took a lot of people out to lunch. I picked their brains. And then within 3 years, I had almost 40 of them. I created this cookie cutter method. And then I realized that I had so much money in equity as a multimillionaire on paper, had a bunch of cash flow coming in. They were actually, the cash flow that I had coming in was actually buying my next deals for those size properties. Realized I was going to lose my equity, decided that, started learning about emerging markets. And I thought, well, I can either go into cash or I can move my money into other markets that were going up. I happened to be at the right place at the right time. But after that, I started figuring out where the right place at the right time was. And that was Montgomery, Alabama. The Kia Flint was being built there. From Montgomery, I bought a 40 unit and then an 80 unit. And I went to Jackson, Mississippi for 350 unit. And then I started walking across the bottom of the United States up to almost 9,000 units.
That's the short version. That's the short version. Yeah, there's books written on this actually. And I love it because just like you said, you know, I think you said people like you can do it too, right? And a lot of our listeners are aspiring or current operators, you know, and just showing that, you know, most of us we weren't born with riches. That's not how we bought this stuff. We built it, you know. So I love that story. And one thing that I think everyone glosses over, Dave, and your book, I think on emerging real estate markets, it's the white cover one behind you. That is probably my favorite market related book in the industry. Not a lot of people write about this kind of stuff, but you know, you talk about you were in the right place at the right time in Boston and you realize, wow, maybe there's a change coming. You went and you figured out how to replicate that and get in the path of progress in these places across the Southeast. Maybe talk about what that looks like a little bit and maybe some key snippets from the book that are someone really needs to understand to make sure they stay ahead of this thing.
Yeah, let me give you how I actually started learning about emerging markets. Is I was buying these properties at auction for anywhere from $50,000 to $90,000. And all of a sudden at the auctions, there's an older guy, Frank Middleton. He was probably in his 70s, but he'd been in Brockton real estate forever. And he started paying like we're all stopping our bidding at like 70, 71, 72. And he's jumping up to like 100, 105, 110, stopping everybody from putting any more bids in. And we're all thinking, wow, Frank's lost it. He's old. He's paying so much for these properties. And then all of a sudden, we all started, he was going to the auctions, he was buying everything up. And then 6 months later, everything takes off. And I was like, Frank knew something. What did he know? So I went to Frank and I said, what do you know? And he said, well, it's all about the economy. It's all about jobs and job growth. And he started explaining to me what makes markets move. That we had a new mayor in town, and that's really important. They have strong leadership, and they had just brought the MBTA from Boston down to Brockton, and now we have transportation. You don't have to own a car to work in Boston. He says all these factors. And I was like, well, where do I learn more about this? And he recommended a couple of books to me, and I started reading them, and I realized that, Brockton was going to start, it was near the peak, and I needed to move my money. So I started following job growth, and I started following household formation. So those are the two big things that move markets. And then from there, once you find a market that you think you like, you call the Chamber of Commerce, and you ask them, what are you doing to attract these jobs? And they could be doing a number of things, but there's typically 4 things that they do. They offer free money, free land, tax abatements, low interest loans. And it's either one or better, a combination of those things. And that's what attracts businesses into an area. After we find out what they're doing, then the next question is how strong is the leadership? Because without good leadership, the market's not going to move. And once we get those questions answered, we make a decision as to whether or not we want to be in that market.
So many nuggets there, and that just scratches the surface. Everyone, go read that book, Emerging Real Estate Markets. You'll be glad you did, especially if you own real estate, because wherever you are, you need to know what part of that cycle you're in. To Dave's point, if he hadn't figured this out, he might have been in Brockton a little bit too long and not have been able to scale the way that he did. Now, one of the analogies I like to use with that is, you can find a deal in any market at any time in the country, right? And that when I say a deal, that's something that maybe is under market rent, needs a little bit of rehab, can be nicer than when you found it, and therefore worth more. But if you're going to go put all that work in, and do what we call the forced depreciation or the forced value add, why not fix up a boat that's in a lake where the water's rising, so you can actually drive that boat at full throttle and not dragging on the bottom of the lake. So it's just, think about it that way. That's really the analogy, I think. How do you think that sounds? Is that kind of a accurate rendition?
Yeah, absolutely.
People make fun of my analogies sometimes.
That boat in the Swift River, where the river is swiftly moving downstream.
That's an improvement on it, because now your relative velocity, you're going faster downstream than if you're going against the current. That's better.
That's exactly it. Because when you take what you just said, you take a value add, and you also couple that in an emerging market where it's appreciating rapidly, then boom, you make money. You make money faster than you can ever believe the first time it happens. And after the first time it happens, you move into another market and you expect it to happen, and it does. And you're like, holy crap, this is unbelievable.
Dave just fixed my analogy. Go with the current, not against the current. There you go. Fantastic. Have you heard about the Multifamily Investor Nation Summit coming up on January 20th? If you've never been, it's a 3-day information-packed event for multifamily investors with over 1,000 attendees and over 50 speakers. Not only will you hear from experts about finding deals, raising capital, underwriting strategies, selecting markets, and so much more, but this year, our partners here at Quattro Capital are excited to be participating with 3 speakers at the event. Our amazing Kim Wendland will be speaking on the often neglected subject of asset management, how to make the machine hum. While our most interesting man in real estate, Maurice Philogene, will be speaking on how to leave your corporate job for a freedom lifestyle. I personally will even be speaking on the topic of how to perform due diligence on multifamily assets before you purchase them, and the not so common things to watch out for. Go to mfinsummit.com to grab your ticket and use promo code Quattro to get $100 off of your full access pass. Whether you are new to multifamily investing or a seasoned investor, you do not want to miss this event. Join Team Quattro at the Multifamily Investor Nation Summit. Visit mfinsummit.com, promo code Quattro. That's mfinsummit.com, promo code Quattro. Well, so I think you threw out a number earlier that throughout your career, you've operated at least 9,000 units around the country. What are some of the biggest takeaways? And I know you've told me this, as a mentee numerous times. the operator who has 250 units has to behave and operate and be structured differently than the one who has 5,000 units and so on.
Yeah.
So what are some of those lessons you learned along the way as you were getting bigger that might prevent some of our listeners from making the same, mistakes or being aware of themselves as they grow?
Right. So as you're growing, you have to always be building your infrastructure ahead of yourself. Typically what happens is the first deal is always the hardest, and that's the biggest struggle. Unfortunately, some people never get to their first deal, but those that do, they get to their first deal, and because they built their systems or implemented their systems, they built their teams, that second deal usually comes within 90 days after the first, because everything's already in place and you've closed, so you have all the confidence in the world that you can do this. So then the second one comes, and then the third one comes, and before you know it, you get 4 or 5 deals, and you think, holy crap, this is a business, but yet you haven't really set up your business systems. So the people that are the most successful are the ones that set up their business systems, and assume success at the beginning. And they don't treat it like a hobby. They don't try to do one-off deals. They don't try to get rich quick. They build their systems as they're moving along, and they build right. But at the same time, they still need to be looking ahead, because at 1,000 units, that's your first infrastructure task. Do you have the proper infrastructure in place to do 1,000 units? And that's usually third-party management, other people managing the properties. You might start off managing yourself with the small ones like I did, but once you start getting over larger size apartment buildings, 80, 100 units, 150 units, you typically go to third-party management. And then, your next step is 2,500 units. And then you need a completely new infrastructure for 2,500 units. And you've got enough, you've got enough size in order to decide whether or not you want to have your own management company. That's a big decision, because that could be a big pain in the ass. That could be something that takes you down. It may take away your focus from actually growing your portfolio. But every 2,500 units after that, your infrastructure changes. So what you've got to be doing, we made this decision at 2,500 units. We wanted to be at 10,000 units. We knew that. So we could hire somebody to take us to the next level at 5 that had the experience of managing 7,500 units, and we could get him for 90,000 a year, or we could pay 140,000 for the guy that had experience managing 12,000 units. And we knew where we wanted to go. We wanted to go to 10, so we took the 12 and paid the extra money, earlier on, when we maybe couldn't afford as easily as we could have when we got to 9,000 units. But at the same time, it's always looking forward in building.
Yeah, and a couple of things you said there. One thing I heard was, if you really want to scale and get to that next level, you got to be that operator before you're there, and that's going to require taking some of your profits and investing back into the company at certain levels, right? Hiring that individual, paying for that accountant, having those systems. And biggest mistake that I see operationally, guys, hire a decent accountant from the beginning, because you're going to get hit with your first tax year, and if your stuff isn't together, oh buddy, it's coming. It's a mess. So I love that. Now,
that's a good point that you made, because as you go through real estate investing, you will go through different size accountants. Like my very first one was the H&R Block. I don't even know they're still around anymore, but that was my first. And then I realized, when my taxes started getting thicker and thicker and thicker, they couldn't do it. And then I had a former IRS agent, and then all of a sudden he kept putting me on extensions, realizing that my taxes were so deep that, it was like, oh, I'll do Lindahl's later. Finally we do them in October. And then I got a larger company, and then a larger company after that. So yeah, you're dead on there. Get a really good accountant right at the very beginning.
Yeah, they've got to grow with you. So, well, that is fantastic. So, as far as operating some of these properties, what are some of the biggest challenges that you've seen in your career? You've operated a lot of properties from, I'm going to say mid-level value adds to pretty deep stuff. But what are one or two of the biggest lessons you learned in the operational world, that properties taught you for next time?
Yeah. So when you start doing third-party management, you've got to prepare to fire that management company the day you hire them, because maybe 75% of them will work out. You're going to be firing management companies if you're in this business for any long term. So you always are a co-signer on the account. If you're not a co-signer on the account, you're dead, because they've got your money, but you want to get rid of them. You may be paying, for 2 management companies, in the contract should always say there's a 30-day out on both sides. Yes, you'll sign it for a year contract, but there's a 30-day notification for both sides to get out of the contract. And then, you may be paying both management companies for a month, but you've got rid of the bad one, you get the new one in, and you've got your money. So that's really important. Third-party management, you make decisions, but they don't implement them right away. And you got to be watching out for the typical management CMs from third-party management, because you think you've got a great one. They interview well, but you just never know until they start they start performing. And the ones that are scammy, you really don't know that they're not performing until, they've hurt you a little bit. That sucks, but it's part of the business.
Yeah, you're totally right on that, Dave. And, thank you for teaching us that, by the way, because, as we've grown over the last couple of years, we've had to fire a couple. But what Dave's program taught us to do was prepare for a hostile takeover day one, right? And for us, that is, we own the bank accounts, they're co-signers, and that usually it's not their policy, because most owners don't treat that right, and they're taking money out while they're trying to pay bills. So I get why they don't want it, but we just say we don't do that. We own the accounts, you operate out of them. If we had to shut it off at a moment's notice, we could, and protect our capital. And just like you said, with those 30-day out clauses, that has saved our neck on 3 occasions, actually. So appreciate those words of wisdom.
Yeah, that's from the School of Hard Knocks.
Yes. And I think, Dave, you told me this as well. You're never going to learn everything before you do a deal. But if you can at least, Pareto's law, if you can at least learn the 80% of mistakes that will end you in this business, right? And the 20% you learn, like, well, my deal didn't go as good as it could have, but I'm still alive, then it's a win. Yeah. Education's worth it.
Absolutely. Did I teach the boot camp that you were at?
No, you did not. But you taught one later.
I stopped teaching 5 years ago when I had my kids. But every time I taught that boot camp, I would tell people, just write it down, write everything down, because you may not understand it now, but when you get out there in the real world, all of a sudden you'll say, oh, that's what he meant by that.
Yeah.
So there's a lot of aha moments there, but also, you just can't teach everything as well. You have to get out there. You have to get that experience. You have to build that gut. We teach the Trinity. You need a cap rate of 8+, a cash on cash return of 12+, a debt coverage ratio of 1.6. That's a very conservative formula to allow people to get started in this business and be successful. But once you start building that real estate gut, because people come to me and say, oh, Dave, it's such a tight market. Can't I go, make those numbers lower and get into deals? I say, you can, but you're at risk of doing a bad deal. It's like, oh yeah, but I can do a value add and I can do this and that. And he's like, how many have you done before? None. Well, then you can't do it because you haven't built that gut. You don't understand what it takes to actually get that value add done. Once you do a couple, then you can start screwing with those Trinity numbers, because you know how to execute. That's a really important concept for people.
That's absolutely right. And I think that Trinity of being 8% or 8% cap rate, 12% cash on cash, and over 1.6 debt coverage ratio, it lets you make mistakes, right? And let's be real. I mean, we all talk about not buying on pro forma. The real thing is, don't buy on someone else's pro forma, so especially not the ones who's selling you the property. Make your own pro forma. And after you've done a couple of deals, you're going to know if that pro forma is real or not. Like, can you actually achieve that? And do you have margin to achieving it? But on your first deal, if you're betting the house on what you're going to do tomorrow and you're wrong, you lose the house, right? So that's the dangerous part. So, all right. We're kind of coming to the end of the episode, Dave. I want to talk about a couple of current things real quick, and I'm going to kind of freestyle on this if you don't mind. We're in an area of very, very low debt. Cap rates are very compressed. We've endured COVID, and so this has impacted different parts of the country different ways. We've seen articles on the supply and demand imbalance with housing, and that we're not building enough. Where do you see, at your level, the rental housing market going? I mean, do you think we're due for a crash? Do you think we're due for, inflation? I mean, this is purely Dave's opinion here, by the way. So, I'd love to hear what your thoughts are on where we're going.
I don't think we're due for a crash. I think there's going to be a correction, which we're waiting for. It should have happened after the election, but then COVID hit. And then when COVID hit, it was like, wow, there's going to be this huge opportunity at the end of COVID. And then, what we didn't foresee is all the office and the retail investors coming into the safe spot, which is multifamily, and making the crazy market that we have now. Eventually, COVID is going to subside. The markets are going to start equalizing again. The investors are going to start moving out. We do have, the newest generation, Gen Z, coming through, 73 million. So they're helping with demand, but you still have to be in the right place at the right time. So still looking forward to the correction. We're still in, doing one-off deals like everybody else. There's really no place to go out there and stake a flag and say jobs are coming here. We're doing an analysis right now of coming out of the last 2 recessions, which are the markets that moved first. And then we're going to look at those markets to be putting some flags down.
Fantastic. So to Dave's point, Are we going to see things come down a little bit? I don't know. Maybe we've printed a lot of money. Asset prices might stay up, but we know that debt drives cap rates as well. Debt is low. If debt increases, that's probably going to correct a little bit. Supply and demand, if that goes backwards and we see some people exit this market, go back to other asset classes, it could happen. So be careful how you're buying things today. Make sure you're following those market cycle fundamentals, just like Dave talked about. If you follow that, you're going to be okay.
You got to be really careful how you're buying it.
Yeah.
I get really excited. We 2007, and we bought a bunch of stuff. Everything was going good. We were doing like a deal and a half a month, a complex and a half a month. Come 2008, all of a sudden, boom, crash. And the deals we bought the 6 months prior to the crash, those are probably ones that we, a couple of them we probably would have walked away from. Had we hadn't been so frenzied, going on. It's a frenzied market right now.
Yeah.
You gotta have a good solid value add in there. You gotta have good fundamentals in there, and you gotta know what your exit strategy is gonna be. And you gotta assume. You really need to assume that cap rate's gonna be higher on your exit than it is right now.
Absolutely.
And if you're not, then you're making a big mistake.
Yeah, you got to at least look at that data point. You're absolutely right. Well, Dave, this has been an action-packed episode. We could talk for days, you and I, on the things that you've probably forgotten that I'll never know of this market. So I do appreciate you coming on. But I'd love to quickly go to the Quattro Trio and ask 3 questions we'd like to ask all of our guests. The first of which being, Dave, what is your superpower in this industry?
My ability to look 3 to 5 steps ahead.
That is true. And I think we saw that in how your career developed and how you had the foresight to figure out how that guy was buying properties higher than you could, right? So that's fantastic. The second question, what is your biggest failure and what did it teach you? Give me some dirt.
I bought a 400 unit in Huntsville, Alabama. I bought it for $7 million, planned on putting $2 million into it. Thought I was going to walk away with a $4 million profit. It was 46% occupied, but 24% economic occupied. It was my fourth big deal. And man, I thought it was a 2-year turnaround. I owned it for 6 years later. I ended up paying off all the investors because they're so pissed off. And I learned so many lessons on that deal. And when people come to me with a deal like that, and I ask them, what's your experience? And they say very little and none. I say, run.
It's not always just about the numbers, is it, Dave?
Right.
Return on effort and sometimes experience. Fantastic. Well, one of the Quattro 4 pillars, Dave, is philanthropy. What philanthropies can our audience support on your behalf?
Camp Shriver here in Massachusetts, camp for handicapped kids and adults, a summer camp. And I'm actually I've been raising funds for that. I'm running the Boston Marathon and the New York Marathon back to back for Camp Shriver.
Fantastic. And Dave, it's August right now. I'm not sure when this episode will air on the fly here, but if we miss this one, I know there's another one coming up after that because this is a recurring event. Tell us what's coming up in our world today as an RE Mentor event that our listeners can come attend.
Ultimate Partnering in Dallas, October 1 to 3. And I can explain it, but you've been there, so you could probably explain it better from the eyes and ears of a participant.
I've been there. Imagine a massive conference where there are more like minds in one room than you'll ever find. I actually met the partners of Quattro Capital at one of these events years ago. Okay. So the right people to mesh minds with and ideals with and morals with will be around here. They're all going to have like goals and things that you're looking for here. It's a place where, people who are looking to invest in deals go to find people like us who sponsor and acquire and run them. It's where the opposite happens. There will be speakers, right and left up on stage throughout the entire time, whether you're outside networking or in the conference rooms or the ballroom rather. You're going to have people talking about different aspects of this industry, market, products that can help you, things of that sort. It's a super inspiring time. I recommend if you don't make this one, make the next one. And I think I just gave a sales pitch and didn't realize it, Dave. So well done.
Awesome. That's at ultimatepartnering.com. And by the way, how many deals have you guys done since then?
Oh, since then, we are in the 17 range right now.
17 deals in Ultimate Partnering.
Yes, we met at Ultimate Partnering. That's right. So we scaled very quickly, but just like Dave said, we paid attention to how we scale. And that continues to be our biggest focus, is making sure we don't fall over the bow of the boat and make sure to keep don't get out in front of our skis, right? If you want to think of it that way. So fantastic. Well, Dave, thank you so much for going on. If anyone of the listeners wants to get in touch with you, what is the best way to do that?
They could go to rementor.com And through there, you could reach out to me. Usually you reach out to me through Jeannie, who you know well.
Yes.
And if you want to talk to me personally, get on my schedule.
Yes. What I love about this team is they're so willing to help at all levels, whether you're a beginner, an expert, or somewhere in the middle. They have the right network. The network is worth, you know, the amount of deals you're going to do, because that's, you know, that's where you're going to meet the right people to partner with and work with and help you get to the next level. So thanks, Dave, for being on here. And by the way, that website will be in the show notes. If you scroll down, don't try to write it down while you're driving. Safety first. Thank you, everyone. This has been another episode of the Real Estate Runway Podcast. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.